Hi, I'm Charles Brown, a portfolio manager here in Chicagoland. I've been doing this for 30 years, and today, this money lesson is about how corporate earnings affect stock market performance. You know, people ask me what really moves the stock market. In CB3's 3-on-3 video series, we talk about social and political, fundamentals and news, and technical analysis as the three significant contributors to stock market movement. Today's lesson on corporate earnings belongs in the fundamentals category. The relationship between a company's earnings and its stock price can be complicated. There are many factors that determine a fairly valued stock, some of which you see on this graphic. High profits don't necessarily mean a high stock price, and big losses don't always lead to a low stock price. Two of the major factors that influence stock price are current earnings per share, or EPS, and the promise of future earnings. Now, investors are willing to pay for future earnings unless, of course, those future earnings disappoint investors' expectations. Looking at this chart, you'll see stocks track roughly in line with a multiple of their earnings. That is until the year 2007, when, as you can see, price ran away from earnings to the upside. Do you see that ugly red line plummeting? What began as a market correction turned into a full-fledged bear market in 2008. Corporate earnings, among other factors, did not meet investors' expectations, and ugly things can happen when corporate earnings disappoint investors. Before most companies report their quarterly financial results, analysts predict the EPS for the quarter based on the company's guidance and other factors. If a company beats those projected earnings, its stock price usually goes up. But if a company fails to reach those projected earnings, its stock price most likely will decline. Let me take this graphic full screen so you can see the third quarter to date earnings scorecard. This scorecard is a sector-by-sector ranking of those stocks that beat and those that underperformed their earnings estimates. As of November 6, just a few days ago, 72% reported above, or that is better than forecasted earnings, but that still means that 28% took it on the chin. I hope you enjoyed this money lesson about how corporate earnings are a major driver behind stock market performance. Thanks for watching. Please give us a like if you found this money lesson useful. I'm Charles Brown, and we'll see you next time.